3 months, 6 months, maybe even more. You have probably heard that your emergency fund should cover 3 to 6 months of expenses. That sounds simple, but 3 months may be enough protection for one household and dangerously thin for another. A married couple with 2 stable salaries, no children, and strong insurance does not face the same financial risks as a single parent earning commissions. A renter with a newer car does not face the same repair risk as a self-employed homeowner with an aging vehicle. So the question is not simply, what number does everyone recommend? The better question is, how much emergency savings does my household actually need? By the end of this video, you will know how to calculate a practical emergency fund target using your essential expenses, income stability, household risks, insurance exposure, and the financial disruptions most likely to affect you. You will leave with a number based on your financial life, not a generic rule copied from someone else. This video is for general educational purposes. Your appropriate savings target will depend on your personal circumstances. Let's begin. First, why does this matter? According to the Federal Reserve's latest report on American household finances, 63% of adults said they could cover a $400 emergency expense using cash or its equivalent. The same report found that 55% of adults had emergency savings sufficient to cover 3 months of expenses. That means millions of households remain financially vulnerable to an unexpected bill or a temporary loss of income. Without savings, a car repair may become credit card debt. A medical bill may require a loan. A few weeks without income may force someone to miss payments or withdraw money from a retirement account. An emergency fund creates distance between an unexpected event and long-term financial damage. But before we calculate the amount, we need to define what an emergency fund actually is. An emergency fund is cash reserved for expenses that are both necessary and unplanned. Examples may include an urgent car repair, an unexpected medical bill, a broken heating system, emergency travel, or a temporary loss of income. An emergency fund is not vacation money. It is not money for holiday shopping. It is not a planned home renovation, and it is not money for a predictable annual insurance premium. Those are real expenses, but they should normally be handled through your monthly budget or a separate sinking fund. Emergency savings should protect you from the expenses and income disruptions that you could not reasonably schedule in advance. Now let's calculate your target. Step 1. Calculate your essential monthly expenses. Do not begin with your complete lifestyle spending. Begin with the minimum amount required to keep your household functioning safely. Include housing, basic groceries, utilities, insurance, necessary transportation, minimum debt payments, required childcare, essential medications, and healthcare, and any other obligation that you could not realistically stop during a financial emergency. Do not automatically include restaurant spending, vacations, entertainment subscriptions, optional shopping, or other expenses that could be temporarily reduced. Imagine that your normal household spending is $6,000 per month, but during an emergency, you could reduce your spending to $4,000 while still covering every essential obligation. Your emergency fund calculation should begin with $4,000, not $6,000. This difference matters. Using your complete lifestyle expenses may produce a target that feels unnecessarily large. Using an unrealistically low number may leave your household underprotected. Review several recent months of bank and credit card statements. Separate essential obligations from flexible spending. Then write down one number, your essential monthly expense total. Step 2. Evaluate your income stability. The number of months you need depends heavily on how predictable and replaceable your income is. Ask yourself, is my household supported by one income or more than one? Is my income salaried, hourly, commissioned, seasonal, or self-employed? How stable is my employer or industry? If I lost my job, how long might it take to find comparable work? Do both earners in my household work for the same employer or depend on the same industry? A household with 2 reliable incomes from different industries may be able to operate with a smaller reserve than a household depending entirely on one variable income. Someone with a stable government position may face a different risk from a salesperson whose monthly income depends on commissions. A self-employed worker may need more protection because revenue can change suddenly, while business expenses continue. Use the familiar 3 to 6 month range as a starting point, not as a law. A lower risk household may begin evaluating a target around 3 or 4 months of essential expenses. A household with moderate income risk may consider approximately 4 to 6 months. A household with significant income uncertainty may decide that that 6 to 9 months, or potentially more, provides more appropriate protection. These are planning ranges, not official rules. The correct number depends on how quickly your household could recover after income stops. Step 3. Evaluate your household risks. Income loss is only one type of emergency. Your household may have other risks that justify a larger reserve. Consider your dependents. A household supporting children, aging parents, or relatives may have less flexibility to reduce expenses. Consider your insurance. A high medical deductible means you may need to pay thousands of dollars before insurance covers more of your care. Review the deductibles on your health, auto, and homeowners policies. Consider your transportation. An older vehicle or a long daily commute may create a greater repair risk. Consider your housing. Renters can still face emergencies, but homeowners are responsible for repairs such as plumbing, heating, electrical systems, appliances, and roof damage. Consider your health and employment benefits. Paid sick leave, disability coverage, and severance may reduce some risks. Limited benefits may increase the amount of cash protection you need. No single factor decides your target. The goal is to understand how many important obligations could continue even when your income does not. Step 4. Identify your most likely financial shock. Ask yourself, what is the most likely event that could force me into high interest debt during the next year? Your answer may be a medical deductible, it may be a major car repair, it may be a home repair, it may be several weeks without commission income, or it may be unpaid leave while caring for a family member. Review the unexpected expenses you have faced during the past few years. Look at what those events actually cost. Then compare your largest likely shock with your monthly expense target. For example, suppose 3 months of essential expenses equals $12,000, but your household has a $10,000 health insurance exposure and very little ability to absorb a large medical bill from monthly cash flow. That risk deserves attention when setting your target. Your emergency fund does not have to cover every possible disaster. That would be unrealistic. It should provide meaningful protection against the events most likely to damage your financial system. Now we can create a practical formula. Your base emergency fund target equals essential monthly expenses multiplied by your selected number of coverage months. Then compare that result with your largest likely near-term financial shock. If that shock would exceed your base protection, consider increasing the target. This is not a scientifically perfect formula. It is a transparent planning framework. Its purpose is to connect your savings target to the risks your household actually faces. Let's apply it to 3 examples. Example 1, a dual income renter. Imagine that Daniel and Emily both have stable salaried jobs. They work in different industries, they have no children, they rent their home, carry strong insurance, and have reliable transportation. Their essential expenses are $4,000 per month. Because they have 2 stable income sources and relatively limited household risk, they may begin with approximately 3 to 4 months of essential expenses. That creates a target range of $12,000 to $16,000. They may still choose a higher target for additional peace of mind. But their situation may not require the same cash reserve as a household depending on 1, unstable income. Example 2, a single parent with variable income. Now imagine Rachel. She supports 2 children and earns a salary plus commissions. Her essential expenses are $4,500 per month. Her income changes throughout the year, and replacing her job could take time. She also has a high medical deductible and depends on 1 vehicle to reach work. Rachel may decide that 6 to 8 months of essential expenses provides more appropriate protection. That produces a long-term target between $27,000 and $36,000. That amount may initially feel overwhelming, but it is a destination, not a demand to save everything immediately. Rachel can build it in stages. First, she can protect herself from the most likely small emergency. Then she can reach 1 month of essential expenses. After that, she can continue building toward the complete target. Example 3, a self-employed homeowner. Imagine Marcus. He owns a small business, and his monthly income changes considerably. He owns his home and has an older heating system. His essential household expenses are $5,500 per month. Marcus may decide that 6 to 9 months of household expenses is appropriate because replacing lost business income may take longer than replacing a paycheck. That creates a potential target between $33,000 and $49,500. But Marcus must also keep several categories of money separate. Money reserved for taxes is not his emergency fund. Money required for business operating expenses is not his personal emergency fund. And money saved for a known home repair is a sinking fund. It's not emergency savings. Different dollars have different jobs. Counting the same money in multiple categories creates a false sense of security. Now let's discuss where the emergency fund should be kept. The primary purpose of emergency savings is availability, not maximum growth. The money should generally be safe, accessible, and separated from everyday spending. For many households, that may mean a dedicated savings account or another appropriate deposit account at a federally insured bank or credit union. Keeping it separate from your main checking account can reduce the temptation to spend it on non-emergencies. The account may earn interest, but chasing the highest possible return should not come at the cost of safety or access. Emergency money generally should not depend on the short-term performance of stocks, cryptocurrency, or other volatile investments. Markets can fall at the exact time you need the money. Your retirement account is also not an ideal emergency fund. Accessing retirement money may create taxes, penalties, lost investment growth, or other consequences depending on the account and circumstances. A credit card limit is not an emergency fund. Home equity is not immediately accessible cash, and money already assigned to taxes, insurance, tuition, or business expenses is not available for a different emergency. Now let's build the fund without becoming overwhelmed. Begin with your most likely small financial shock. Perhaps that is $1,000, perhaps it is one insurance deductible, perhaps it is the expected cost of a major car repair. Once that first layer is complete, work toward 1 month of essential expenses, then continue toward your complete target. Set up an automatic transfer after each paycheck when your cash flow allows it. The amount does not have to be dramatic. $50 every payday is better than waiting indefinitely for a perfect month. Increase the transfer when your income rises or a debt payment ends. Consider directing part of a tax refund, bonus, gift, or other one-time income toward the fund. If your income is irregular, consider saving a percentage of stronger months instead of forcing the same dollar amount every month. Monitor your checking balance so automatic transfers do not create overdraft fees. The system should support your financial life, not destabilize it. When should you use the fund? Use 3 questions. Is the expense necessary? Is it unplanned? And would delaying it create a larger financial or personal problem? A broken furnace during winter may qualify. A routine holiday purchase does not. A medical bill not covered by insurance may qualify. A discounted television does not. Do not become so emotionally attached to the account balance that you refuse to use the money during a genuine emergency. That is the purpose of the fund. After using it, pause and create a plan to rebuild it. Finally, recalculate your target when your life changes. Review it after changing jobs, buying a home, having a child, becoming self-employed, taking on a dependent, experiencing a major change in health or insurance, or significantly increasing your essential expenses. A target that was appropriate 3 years ago may no longer protect your current household. Here is your action plan. First, calculate your essential monthly expenses. Second, evaluate the stability and replaceability of your income. Third, identify the household risks that could increase your need for cash. Fourth, estimate the largest financial shock you are reasonably likely to face. Fifth, select a coverage range and calculate your target, then build it 1 layer at a time. Your emergency fund is not measured by how impressive the balance looks. It is measured by how much financial disruption it can absorb before your household is forced into debt. 3 months may be enough for one household, 6 months may be appropriate for another, and someone with greater income or household risk may decide that more protection is necessary. The correct target is not the number that sounds most impressive. It is the number that gives your household enough time and flexibility to recover when life does not follow the plan. If this video helped you calculate a clearer emergency savings target, subscribe to Wealth for Legacy. We create practical financial education designed to help you build wealth, protect it, and pass opportunity forward. Keep building your legacy.